Okay, I wanted to go ahead and go through an example of a merger with some contingent equity consideration, and then I want to bring in what's the topic of what's referred to as the remeasurement period. So first, let's do the easy part. We have, this is also a mid-year acquisition. Assume that on August 1st, Big acquires Little company and a transaction to be accounted for as a merger. Little has the following trial balance at the date of acquisition. Again, we have all of our various assets and contra assets. We have our liabilities, we've got equity, we've got sales, expenses, and dividends declared. Strange as it may seem, and this is something that's changed back and forth a number of times over the years, when we acquire a subsidiary mid-year, we are not going to assume or acquire their revenues and their expenses. Again, what we're essentially doing is we're buying this bundle of net assets. This does present sort of a strange problem for comparison purposes. And again, this was August 1st acquisition, but let's make it more true. Let's say the acquisition was on December 15th. So December 15th, Big company acquires Little company, and they're going to essentially zero out all of the revenues and expenses to date for Little company. And so basically in the Big income statement for the year of acquisition, it'll have all of Big's revenues and expenses for the full year, and then Little's revenues and expenses just for the last 2 weeks of the year. The problem is that doesn't provide a good basis for projections into the future. Whereas this year's income statement is going to be based on Big for a full year and Little for 2 weeks, next year it's going to be Big for a full year and Little for a full year, obviously. So we suffer a little bit in terms of the data being useful for projections. But again, in the merger, what we're essentially buying is we're buying this collection of assets and liabilities, which we're going to go ahead and record at fair value. So again, let me go ahead and get rid of that book value column just to free up a little bit of space here. As again, as I wander off screen and change the margins a little bit out. There we go. Okay, so what is the fair value of what we're acquiring? Let me go and put these in bold. Maybe that'll be a little bit more visible. What is the fair value of what we're acquiring? Basically, the assets. We got 140, 200, 230 minus liabilities of 30, $200,000 of net assets. There's no mention of any additional intangible assets like there was in the other example we ran through. How much are we paying for this $200,000 in net assets? Well, we're going to give up 20,000 shares of $1 par value common stock, current value $21 per share. So we're going to give them stock worth, 20,000 times 21 is $420,000. Plus, we're going to give them contingent consideration. So again, here we have our contingent consideration based on earnings growth. If earnings growth is less than 3%, they're going to get no additional shares. 3 to 5%, they get 1,000 shares. 5 to 7%, 2,000 shares. 7% plus 3,000 shares. We have our, again, admittedly subjective probabilities for those events happening. So number of shares times the probability. Again, I don't need to clean that up. 0 times 30 is 0, so this is the expected value. 1,000 times 40% is 400. 2,000 times 20% is 400. And 10% times 3,000 is 300. For a total expected value of 1,100 shares. On the date that we enter into this agreement, those 1,100 shares are worth $21 each. So the contingent consideration, again, 1,100 shares times $21 times $21. So the total value of the consideration is $443 100. So again, we're buying $200,000 of net assets. For $443,100. So we're paying $243,100 above the fair value of the net assets, and so that's going to be our goodwill. Okay, so let's go ahead and record this acquisition. So, and again, I'm not going to list all the assets individually. I'm simply going to say net assets, $200,000. If you're taking my class and this is on an exam, please do not simply write net assets. You have oodles of space on your paper to write out all of the individual assets. Anyway, we're going to have our net assets of $200,000. We're going to have our goodwill of $243,100. And again, what are we surrendering? Well, we're surrendering 20,000 shares of common stock. So common stock always at par value. Again, those shares, I already erased it, those 20,000 shares worth $21 a piece. So, 20,000 at $1 par value, there's $20 of excess of par per share. So the paid-in capital in excess of par, or additional paid-in capital, is $400,000. And then we had that contingent consideration, paid-in capital, contingent consideration. And again, I shouldn't have erased that, but I did. That was 1,100 shares worth $21 a piece, which is $23,100. Okay. Now, I'm probably going to scroll down a little bit here. It says that some additional information. It says on 11/1/10, Big discovered that some of the property, plant, and equipment acquired in the merger was obsolete and not worth the originally estimated value. The true value of property, plant, and equipment at the date of acquisition was $85,000. And again, we had initially assumed, I apologize for scrolling back and forth like this, we originally assumed that the property, plant, and equipment was worth $90,000. So basically that number was overestimated by $5,000. The question then becomes, what do we do with that? Now, when there is a business combination, a merger, we have some window of time. It's not clearly specified what that window of time is. It's less than a year, where it's called the remeasurement period. Because in a merger, we do our due diligence, but we might find that we made a mistake in valuing some asset. So if we find new information about a state of being that existed on the date of acquisition, we can go ahead and adjust those asset values up or down to reflect the true value. This sort of gets into the topic similar to what you would have talked about with subsequent events as being reported on the balance sheet. If you have a balance sheet dated 12/31/10 and you discover on January 15th, 2011 that some of your merchandise was destroyed back in November, then you go ahead and on your balance sheet you reduce the inventory reported on the year-end balance sheet because at the end of the year that inventory didn't exist. In contrast, if your fiscal year end is December 31st, 2010, and there's a fire on January 5th that destroys your inventory, on your balance sheet you would still present what actually existed at the end of the year. Of course, you have a note disclosure saying, hey, this stuff doesn't exist anymore, but you want to report what existed on the date of acquisition. So if we find out that that number was in fact incorrect, we're going to go ahead and adjust the value of that equipment downwards from $90,000 down to its true value of $85,000. So we're going to go ahead and reduce our property, plant, and equipment by $5,000. And then the question, again, over here I simply called it net assets. So if you want to be consistent, you simply call that net assets. The question then becomes, what do you debit? And the basic answer is we're going to treat that as an adjustment to goodwill. And this bugs some people, myself included, because maybe this should be, instead of being an adjustment to goodwill, maybe this should be a loss. Maybe you got snookered, you got taken. You were misled into believing that this asset had certain value. Turns out it doesn't. Does that make the goodwill any greater? Shouldn't that be, in fact, a loss due to negligence on your part? The counter argument is that when we acquired this firm, the price we paid for it, $443,100, was based on the value in aggregate of the firm. And if some part of that value that's attributable to equipment falls, then the portion of that value that's attributable to goodwill must necessarily rise. At extreme, let's say that you were really taken, and in fact, none of these assets exist. In that case, again, there would be a strong argument for saying, look, this entire thing was a total loss. So I guess at an extreme like that, obviously the logic would change a little bit. Let's go ahead and move this a little bit further just to deal with this contingent consideration again. Let's say that the actual earnings growth after the number of years came in at 4%. So let's say we fell within that band. Because I've noticed that a lot of times people make mistakes when doing this part. So actual earnings growth after a number of years came in at 4%. We're going to give them 1,000 shares of stock. Again, this value we assigned to the contingent consideration, that is cast in stone. We're now going to give them 1,000 shares of stock. And those 1,000 shares of stock are valued at $23,100. So we'll get rid of the paid-in capital contingent consideration. We'll issue 1,000 shares of common stock with a $1 par value per share. The other $22,100 becomes your paid-in capital in excess of par, or your additional paid-in capital, whichever you prefer. Okay, and again, I apologize for the glare up there. You can't see this, but I've got two desks put together with a big stool on top of it, with my camera on top of that, trying to make the angle so that that doesn't glare in your eyes, but who can?